now we'll try to go the other way. Instead of starting with a risk aversion level and calculating an optimal allocation, let's observe an allocation. We'll make an assumption that it's optimal, and from this we'll try to infer a risk aversion level. So before we started with an A, an investor's risk aversion level, and we briefly discussed how difficult it can be to determine this risk aversion level. So let's use our model to see if we can infer some risk aversion level using observed allocations. And if we can infer risk aversion from investor behavior. So here's an example. Assume the same investment universe, so the risky portfolio has a 10% expected return at a 20% standard deviation, and risk-free asset return is 3%. And we observe an investor who has Y equal to 1. Well, what does that mean? We don't observe Y. What we observe is all the wealth in the risky asset or the risky portfolio. So all spiders, no money market mutual fund. And from this we infer that Y equals 1. And we can also assume that we will also assume that this investor is acting optimally. And so instead of using A to solve for Y, we'll use Y to solve for A. Now just quickly, will A be greater than or less than 2? Well, we know that before that when we had A equal to 2, we had a Y of 0.875, but now we have a Y star equal to 1, so we know that A should be less than 2. And here's our equation. We have Y as a function of A, and we're going to set that equal to 1, and now we're just going to solve for A as a function of Y. We'll set Y equal to 1. We'll do the calculation, and we end up with an A equal to 1.75, which is less than 2, which is what we expected. And let's just see what this equation looks like. Sorry, this portfolio looks like, this combined portfolio. So if I have a Y equal to 1, I can see that the expected return of the combined portfolio is exactly equal to the expected return of the risky portfolio. And the risk of the combined portfolio is equal to the risk of the risky portfolio. So I have a 10-20 portfolio. And I can see that the utility is equal to 0.0650, which of course is also equal to the indifferent risk-free rate, or the certainty equivalent rate is the other word for this rate. And this is just an artifact of how we designed the utility function, that the utility level is also equal to this rate. What if instead we observe an investor with Y equal to 0.05? Well, what does this mean? Okay, so this investor has half risky and half risk-free. That's how we interpret the Y equal to 0.05. And we should get a larger A since we have a smaller Y. We do the same math again. Solve for A, plug in 0.5 for the Y, and we get an A equal to 3.50. And so we have inferred the risk aversion level, and again, calculating the combined portfolio values, we can see that the combined portfolio has an expected return of 6.5. It has a risk of 10%, and then this is the certainty equivalent rate of 4.75 or 0.0475 for the utility. The idea is that given observed investment behavior, we can infer the risk aversion level for a particular investor. In practical terms, the way this, at least in my experience, seems to work is that investment advisors will have long conversations with their clients, get to know their clients, and attempt to assess the risk aversion level for this particular client. When we start running these portfolios with sort of a variety of numbers, we'll see that we can end up with a whole bunch of different types of portfolios for a risk aversion level of 1 or 2 or 3 or 4 or 5 or 10 or 20. And in my experience, what portfolio managers tend to do is categorize their clients in 2 or 3 categories: low risk, medium risk, high risk, or maybe just low risk and high risk. And then they'll create portfolios that fit these different categories of clients. A little bit cynically, the goal of an investment advisor is to not get fired. Well, how do you not get fired? Well, if the market goes up a ton and your client doesn't make any money and was hoping to, then you're likely going to be fired. And so you have to sort of make sure this portfolio is risky enough so that this client can take advantage of the upside. But if the market tanks and your client loses a ton of money, then you're also going to get fired. And so you want to be sure that the portfolio isn't so risky that they're also incurring this big downside risk. So it's a bit of a balancing act. A lot of it is your relationship with your client as an investment advisor. But again, my experience is that portfolio managers tend to run sort of 2 or 3 different portfolios: low risk, mid risk, high risk. And we also see this with a lot of products. We're going to see this with target date funds as well. And so this seems to be the practical way that people deal with A. Now, going forward, we're still going to assume some risk aversion level, but at some point we're going to start talking categories. We're going to assign a value of A for our low risk clients, our mid risk clients, and our high risk clients.